The money sitting in your bank account right now does not exist, not in the way you think it does, not in any physical vault, not locked away in some secure room with your name on a box. The number you see on your screen, that balance you've been building, protecting, trusting toward is not money. It is a record of a promise. And that promise is built on top of another promise, which sits on top of another, all the way down until you hit nothing, absolute nothing. And here's the part that should stop you cold. The people who built this system knew exactly what they were doing. This is not paranoia. This is not the kind of thing whispered in dark corners of the internet. This is how the global financial system was designed deliberately centuries ago by men who understood one terrifying truth about human psychology. People will believe in money as long as they never test it all at once. And so long as they never test it all at once, you can manufacture as much of it as you need. You can lend what you don't have. You can charge interest on money that never existed. You can build an empire on a foundation of collective faith and call it banking. Right now, the total value of physical cash circulating in the United States is roughly $2 trillion. But the total money supply, the deposits, the balances, the numbers people see in their accounts, sits above 21 trillion. Where did the other 19 trillion come from? It wasn't mined, it wasn't printed, it was created, conjured into existence by private banks the moment they approved a loan. And the terrifying part is not the scale of it. The terrifying part is that this is not a flaw in the system, it is the system. To understand how something this large became this invisible, you have to go back not to Wall Street, not to Washington, but to a cold workshop in medieval Europe. Somewhere in the 14th century, a goldsmith sat behind a heavy iron door and looked at the gold entrusted to him by his clients. The gold never moved. Day after day, the merchants who deposited their coins almost never came back to claim all of it. They traded the receipts instead. Small paper notes confirming how much gold they held on deposit. Those receipts passed from hand to hand like money itself, because in every practical sense they were money. And so the goldsmith asked himself, if the receipts are the money and the gold just sits here, what exactly is stopping me from issuing more receipts than I have gold? The answer was nothing. Nothing except the small and highly unlikely chance that every single depositor would show up on the same day. The goldsmith calculated the odds. He issued more receipts. He lent them at interest. He became extraordinarily rich on gold he never owned and money he never had. And when his clients came to check their balances, the numbers matched, because the numbers always matched. That was the point. That single act, that quiet, private decision made in a goldsmith's back room centuries ago, is the direct ancestor of every mortgage, every credit line, every corporate bond, and every digital dollar that exists in the global economy today. The names changed, the scale exploded, but the trick is identical. By the 17th century, this trick had been formalized into institutions. The Bank of England was founded in 1694 not as a public service, but as a solution to a very specific problem. The English crown was broke. Years of war had drained the treasury, and the king needed money he did not have. A group of wealthy merchants offered a deal. They would lend the government £1.2 million. In exchange, they would be allowed to issue their own banknotes and charge interest, not just on the government loan, but on money they could now create at will. The debt would be repaid not by the crown, but by the taxes of ordinary English citizens for generations to come. Private investors, not elected by anyone, not accountable to anyone, were handed the power to manufacture money and lend it to governments who would then extract it from their own citizens. This was not hidden. It was written into law. It was celebrated as financial innovation, and within decades, every major European power had copied it. Now let's pull this into the present, because the mechanics of modern banking have moved several steps beyond even the goldsmith's imagination. When you deposit $100 in a bank today, you believe in some reasonable corner of your mind that the money is there, that it exists, that it is waiting. The reality is this. The bank is already thinking about how to lend it. For most of the 20th century, banks in the United States were required to keep 10% of deposits in reserve. Your $100 would produce $10 held back and $90 lent out. That $90 would be deposited elsewhere, producing $81 more in loans. And so on, cycling through the system until your original $100 had multiplied into nearly $1,000 of circulating money. Only the original $100 was real. The rest was debt wearing the costume of money. But here is the part that renders even that explanation outdated. In March 2020, the Federal Reserve quietly eliminated reserve requirements entirely, to zero, not reduced, eliminated. Banks in the United States today are legally required to hold nothing in reserve against the deposits they take. Nothing at all. What that means is worth sitting with. The old story, 10% reserve, $90 lent for every 100 deposited. That story already described a system where 90% of money was conjured from debt. The new reality is that there is no longer even a theoretical floor. Banks do not lend from deposits anymore. They create loans first. The loan comes into existence the moment a bank types a number into your account. That number is new money born from your obligation to pay it back with interest. The deposit is created by the loan, not the other way around. The only leash on this process now is a set of regulations designed not by your government but by a committee of unelected central bankers who meet in Basel, Switzerland, inside an institution most people have never heard of, the Bank for International Settlements, sometimes called the Central Bank of Central Banks. It sets the capital rules that determine how much equity a bank must hold against its risky assets, not reserves. Capital ratios, rules written in Switzerland, implemented globally, governing how much money private institutions can conjure from nothing. And right now, more than 90% of the money in circulation across the developed world is not cash. It is not printed by any government. It is bank-created money, private money, born as debt. Every single dollar of it exists because someone somewhere agreed to pay it back with interest. This design is not neutral. It has three consequences that compound across every generation. The first is inflation, not occasional inflation. Structural, guaranteed, inescapable inflation. Because if the money supply expands continuously, the purchasing power of the money you already hold must shrink continuously. Every dollar of new debt dilutes every dollar already in existence. Saving becomes, over time, a slow-motion loss. The prudent and the patient are penalized by the very architecture of the system. The borrowers and the asset holders are rewarded, not by luck, by design. The second consequence is that debt can never fully be repaid. This is not a social failure. It is a mathematical certainty. Because every dollar that exists was created as a loan, and every loan carries interest, the total debt in the system always exceeds the total money in the system. There is never enough money to pay back everything that is owed. Someone must always default. Someone must always borrow more to keep the cycle alive. The system does not just tolerate debt, it requires it. An economy where everyone paid off their loans simultaneously would not be prosperous. It would collapse. The money supply would implode. The third consequence is a transfer of power so gradual and so complete that most people never see it happening. Banks collect interest on money they created from nothing. Governments borrow from this system and then tax their citizens to pay the interest, transferring wealth from workers to bondholders in a loop that never closes. The wealthy, who own real assets, land, stocks, commodities, businesses, watch those assets inflate as the money supply expands. Workers, whose primary asset is their labor, watch their wages buy less each year. This is not an accident of bad policy. It is the predictable output of a machine built to favor those who lend over those who borrow, those who own over those who work. History has shown us repeatedly what happens when this machine overheats. In 1929, a decade of reckless lending inflated a stock market bubble built on margin and borrowed confidence. When panic hit, depositors rushed to withdraw and discovered the money was simply not there. Thousands of banks failed. An entire economy collapsed, not because farms stopped growing food or factories stopped producing goods, but because the trust holding the money together dissolved overnight. The physical world did not change. The financial layer sitting on top of it stopped being believed. It happened again in 2008. Banks had spent years multiplying credit through instruments so complex that almost no one understood what was inside them. When the housing market cracked, losses cascaded through the system faster than anyone could track. Institutions that had existed for over a century came within hours of complete failure. The government's response was not to dismantle the system. It was to spend trillions of dollars of public money to preserve it, to backstop the illusion, to make sure the trick survived, because the bailouts were not about protecting ordinary people. Ordinary people lost their homes by the millions. The bailouts were about protecting the mechanism itself, because that is what this all comes down to. Not gold, not productivity, not even law. Confidence. The entire global financial system rests on the collective willingness of billions of people to believe that the numbers mean something, that the promise will be kept, that the receipt can be exchanged for something real. And the people who run this system understand this better than anyone. So what does this mean for you? Real wealth is not a number in an account. Real wealth is land, resources, skills, knowledge, assets that hold value when paper promises dissolve. Debt is not neutral. Inflation is not accidental. The dilution of your savings, the rising cost of everything you need, these are not random misfortunes, they are features. You are not powerless. But power comes from understanding the machine clearly enough to stop feeding it blindly. The goldsmith's trick has been running for 700 years. That story is not finished. The next crisis is not a question of if, it is a question of when. History has always rewarded the people who saw the trick before everyone else, the ones who built on ground rather than promises. Now you are one of them. If this changed the way you see your own money, subscribe. History has the answers. I will show you where to look.